Election day has come and gone, and Wall Street can finally breathe a sigh of relief. But what was all the fuss about? Many feared a long wait for election results, disputes over who won, or even legal battles. But none of that happened. By Tuesday night, it was clear that Donald Trump had won the presidency, and Kamala Harris conceded. So, what does this mean for the stock market? The answer: a huge surge. Stocks hit all-time highs, and the market was back in business. But what happens next? With a new president in office, how should investors play the stock market in 2025? Keep watching to find out. If you're enjoying this content, don't forget to like, share, and subscribe for more updates on the latest market trends and strategies. Post-election, market reactions. After the election, stocks jumped sharply. The S&P 500 went up by over 4%, and the Nasdaq Composite gained nearly 6%. The Dow Jones Industrial Average also rose 4%, its biggest post-election gain since 1896. Even more impressive was the 32% drop in the CBOE Volatility Index, VIX, a measure of market fear, showing that the worry over Wall Street vanished quickly. A fresh start, but a different landscape. While many investors are feeling hopeful about Trump's second term, it's important to remember that the economy has changed since his first term. In 2017, inflation was lower, around 2%, and the federal deficit was smaller compared to the country's GDP. The S&P 500 was trading at a lower price-to-earnings ratio of 16.5. Today, things are different. Inflation remains a challenge, the deficit is higher, and the S&P 500 now trades at nearly 22 times earnings, making it more expensive than before. Expectations are also higher, which means the market faces more pressure to perform well. The Trump agenda: tax cuts, tariffs, and deregulation. Donald Trump's policies may not be much different from his first term, but they will have a different effect this time. For example, Trump plans to cut the corporate tax rate from 21% to 15%, put tariffs on Chinese goods and other imports, and reduce regulations. While these moves could boost the economy, they might also increase inflation. Unlike in 2017, when deflation was a bigger concern, today's rising inflation could make these policies harder to carry out without negative effects. Even with these concerns, it's unlikely we'll see inflation reach the extreme levels of 2022, when supply chain issues and the war in Ukraine caused major price hikes. However, bringing inflation down to the Federal Reserve's target of 2% will be tough, especially with core CPI, which excludes food and energy, currently at 3.3%, higher deficits, and rising bond yields. One of the biggest risks to the economy with Trump's proposed policies is the chance of a larger federal deficit. The deficit is already more than double what it was in 2016, and more spending could make the problem worse. If this happens, bond vigilantes, investors who watch for government debt issues, might react by selling long-term bonds, which could push yields higher. The day after the election, 10-year Treasury yield jumped from around 3.6% to over 4.4%, showing market concerns about rising debt. If bond yields keep rising, it could create problems for the stock market, especially since stock prices are already high. The S&P 500 is trading above its 5-year average, leaving less room for growth. The risk is that if yields go too high, investors may start to question whether holding stocks is worth it, as bonds could offer better returns. Valuation concerns: a market at risk of overvaluation. The stock market right now is expensive compared to its history. The S&P 500 is trading at a price-to-earnings (PE) ratio of nearly 22, above its 5-year average of 19. This means investors are paying more for stocks than usual, which could be a problem if earnings don't meet expectations. The big question is whether earnings will grow enough to justify these high prices. Despite these challenges, there's a chance earnings could rise, especially if Trump's policies like deregulation, lower taxes, and more government spending help corporate profits. But, as some experts warn, high expectations can be risky. The market has priced in a lot of optimism, and if those expectations aren't met, the stock market could face a downturn. The Trump effect: financial stocks and small caps. Despite the risks, there are still opportunities in the market. Financial stocks, for example, have already started to benefit from Trump's win. Big banks like Goldman Sachs, Morgan Stanley, and JP Morgan Chase saw their stock prices hit new highs after the election. Financials tend to do well when short-term interest rates are low and long-term yields are rising, creating a good environment for lending. Trump's likely easing of regulations on the financial sector could boost profits even more. Small-cap stocks are another sector that could benefit from Trump's policies. These companies are more focused on the domestic market, so they may do well with Trump's protectionist trade policies. Higher tariffs on China and other countries could help smaller companies, which depend less on international trade, outperform larger global corporations. Industrial and defense stocks. Industrials and defense companies could also benefit from a Trump administration. Companies like Caterpillar, Nucor, and Steel Dynamics, along with defense contractors like Lockheed Martin and Raytheon Technologies, may see more demand if Trump moves forward with plans to spend on infrastructure and boost military spending. Deregulation and lower taxes could also help these sectors. Defense stocks, in particular, have done well under Trump, as he has always supported increasing military spending. This trend is expected to continue, with investors looking to take advantage of growth opportunities in the defense sector. How to play the stock market in 2025. With a new president taking office in 2025, it's important for investors to adjust their strategies to account for the changing economic and political landscape. Here are some key strategies to consider. Number 1, look for value stocks. The stock market is expensive by historical standards, and with interest rates rising, it's important to focus on value stocks. These are stocks that are trading at lower price-to-earnings ratios compared to the overall market. Sectors such as financials, industrials, and energy are likely to benefit from Trump's policies, making them prime candidates for value investors. Number 2, focus on cyclical sectors. Cyclical stocks, which tend to do well when the economy is growing, could outperform in the early years of a new administration. Financials, industrials, and energy stocks are all likely to perform well if the economy picks up steam under Trump's pro-growth agenda. Look for stocks in these sectors that are trading at reasonable valuations. Number 3, watch for opportunities in small caps. Small cap stocks could see a surge under Trump's protectionist trade policies and lower tax rates. These stocks tend to be more domestically focused, which makes them less vulnerable to global trade issues. As tariffs rise on imports, small cap companies may have a competitive advantage over larger companies. Number 4, consider defense and infrastructure stocks. Trump's support for military spending and infrastructure investment makes defense and construction companies appealing for investors. Companies like Lockheed Martin, Northrop Grumman, and Caterpillar could benefit from increased government spending in these areas. Number 5, monitor rising bond yields. Rising bond yields could present challenges for the stock market, particularly if long-term yields rise above the risk-free rate. If this happens, investors may start to question whether stocks are still a good investment. Keep an eye on the bond market, especially the 10-year Treasury yield, as this will be a key indicator of how the stock market responds to rising debt and fiscal policy. Number 6, stay prepared for volatility. While the immediate post-election euphoria may create optimism, it's important to stay prepared for potential volatility in the first quarter of 2025. The combination of higher tariffs, rising yields, and political uncertainty could cause some turbulence in the stock market. Be ready for short-term market fluctuations and adjust your portfolio accordingly. As Donald Trump begins his second term, we can expect some big changes in the U.S. economy and stock market. His policies might boost growth in certain sectors, but they also come with some risks, like rising inflation, a bigger federal deficit, and possibly an overvalued market. So, what should investors focus on? It's important to pay attention to value stocks, cyclical sectors, and small-cap companies. And don't forget to keep an eye on the bond market. Any signs of trouble there could signal a bigger issue. So, how will you adjust your strategy in this new economic environment? Staying informed and flexible is key to navigating the stock market in the coming years. If you found this helpful, make sure to like, share, and subscribe for more insights on how to make the most of your investments.